Hey guys, Tony here. Welcome back. In today's video, we're going to be talking to you, retail traders, about what is retained earnings. I'm not trying to teach you how to become a CPA. We're not practicing for an accounting test here. I want to share with you some high-level thoughts about, as a retail trader, what do you need to know about retained earnings that is important as you're evaluating a stock, and also important to understand when folks on social media are misconstruing retained earnings, or perhaps giving you some bad information because they don't really know what they're talking about. If that sounds like something you might be interested in learning a little more about, stick around for just a minute. We're going to keep it light. We're going to keep it easy. Let's get right into it. We're going to begin with the definition of retained earnings, but I also want to show you visually where you can find it if you're looking at a company's financial statements, or you're looking on a website like Yahoo Finance or stockanalysis.com. Retained earnings are reported quarterly by companies on their 10Qs or 10Ks. They're found on the balance sheet down at the bottom, and they are part of shareholders' equity. If we look at a balance sheet like the one I have on the screen here for Home Depot, we got our assets and liabilities at the top, the shareholders' equity section down at the bottom, and in green I have highlighted where you can find retained earnings. In a second example, if you have a company that has a negative retained earnings, you might see it listed as something called accumulated deficit, indicating that the retained earnings is a negative number. For a very basic definition of what is retained earnings, think of it as the cumulative net earnings or cumulative net profits that a company makes each period, each quarter, after paying for any dividends. For the period that you're looking at, if a company loses money or pays dividends, then retained earnings is going to go down. If the company makes a profit, then retained earnings is going to go up. Retained earnings has a relationship to revenue, but it's not exactly the same as revenue. And let's just do a quick example. If I have a company that manufactures widgets and my company's revenue for the year was $5 million and my expenses for the year were $3 million, I have a net income of $2 million. If I paid out $500,000 in dividends, then I would have a retained earnings, what is left from the net income minus the dividends. My retained earnings would be $1.5 million for the year. When you're looking at a company doing a little bit of analysis on the financial statements, you might wonder, what is the importance of retained earnings? And as we have here on the slide here, retained earnings are a source of reinvestment and business growth for the company. The higher the company's retained earnings, the more it can grow and expand. Especially for a company in a growth phase, a new company, retained earnings are critical. New companies want to retain all of their income so that they can reinvest it in growing the company. More stable companies might not retain as much, and investors might expect that mature companies pay out some of their income as dividends. Warren Buffett would tell you that having a healthy retained earnings on the balance sheet contributes to the financial stability and flexibility of a company. When times get tough out there in the market or in the economy, as they sometimes do for companies, having a higher retained earnings can often help the company weather those tough times without having to resort to increasing debt or less favorable solutions. On the flip side, when we see a negative retained earnings or a accumulated shareholder deficit, that might be a red flag to you as an investor that you need to spend some time digging deeper and understanding why this company is incurring losses. Why is that shareholder deficit accumulating? I know for many of you, if you're not a financial guru or a CPA or a financial analyst, that retained earnings might sound kind of nebulous. What exactly does it mean? Remember, we're thinking about that money that the company has left over after they make their income and pay their expenses. There is some leftover money. What can they do with it? So let's go over the bullets on this list real quick and see exactly what can companies do with retained earnings. They can be invested to launch a new product or a variant of a product. They can be used to repay any outstanding debt. They can be distributed to shareholders in the form of dividends. They can be used for share buybacks. They can be invested to expand existing business operations. And finally, the money can be used for any possible merger, acquisition, or partnership that leads to improved business prospects. The other thing that is worth knowing, the second bullet point on this particular slide, the key takeaways, is that if earnings are positive and you have leftover money, it is the decision of management what to do with that money. It is the decision of management to decide how to invest that money or to distribute it to shareholders. Our job as investors is to judge them on, are they effectively managing that money? And we use ratios like the return on equity ratio or the payout ratio of dividends to judge them on their effectiveness of managing that money, and especially to judge them on those ratios relative to other companies in their sector. Analysts may be looking at retained earnings over a period of time, say a 5-year period or a 10-year period, and asking themselves, are retained earnings growing or are they decreasing? Investors, on the other hand, are going to be looking at some other things, like I just mentioned, the return on equity. Is that money being effectively invested? Investors might not care if retained earnings is growing. They want those dividends. They want their piece of the pie. We have been talking about companies that have positive retained earnings, but there are some out there that have negative retained earnings or a accumulated shareholder deficit. So let's talk just for a minute about what that means to you as an investor. If you see negative retained earnings on the balance sheet, that is, as I said earlier, a red flag that you might want to dig a little bit deeper. Having negative retained earnings on the balance sheet is going to be an indicator to you that possibly the business is going to have some problems growing because there's just not available cash. It does also put the company at a little bit of risk because there's just not that safety net there. And you know what happens when companies don't have a safety net and when they don't have cash? They often must resort to taking on new debt to bring in cash or selling shares into the market, what we also call dilution, again, to get that safety net back on the balance sheet. Another thing to think about is the second bullet here as you're comparing companies out there, company A to company B in the same sector, and you see that company A is doing really well, the share price is going up. Company B maybe not doing so well and its share price is struggling. Well, if company A has positive retained earnings and company B has a accumulated shareholder deficit or negative retained earnings, company B is just not going to be as attractive of an investment for Wall Street investors, big institutions, the ones that you need in there to drive that price up. Things that can contribute to a negative retained earnings include the most obvious, a net income loss. They also include the payment of dividends. And if those net income losses continue quarter after quarter, you start getting this bigger and bigger cumulative negative retained earnings. But the good news is if you're invested or thinking about investing in a company that has negative retained earnings, it's not always all bad news. It is not the death knell of a company. And that is probably the biggest thing that I hear people out on social media misconstrue, that negative retained earnings and accumulated shareholder deficit is a death sentence for a company. Not necessarily true, guys. Let's talk about that for 1 second. As we've talked about here many times, Wall Street is primarily interested in earnings, positive earnings and free cash flow. And although negative retained earnings is a red flag that there has been some problems, if things change, like the net income of the company flips from negative to positive and they start generating free cash flow, then guess what? That negative retained earnings starts getting chipped away, and Wall Street is going to be more focused on the future outlook of the company. Can they begin to generate ongoing, regular, positive earnings and free cash flow? And they're not going to focus so much about the fact that there's a negative retained earnings on the balance sheet. They're going to focus on future positive earnings. And as we talked about on this earlier slide, an analyst is then going to look at the trend of retained earnings. Even though it's negative, is it improving? Is it getting back towards a positive number? Even if that's going to take a while. If the trend reverses due to improved earnings, positive earnings, then the analyst is going to take note that retained earnings is improving. Let's finish up here by talking about some nerdy stuff, the formula and what ratios are related to retained earnings. I'm going to keep this very high level because I'm not trying to teach you to be a CPA, just to roughly know at a high level, how does this stuff work? When we're looking at a balance sheet, we have retained earnings from the previous period. We're going to add to that the net income or subtract any net loss, and we are going to subtract any dividends that were paid, and that will give us our new retained earnings for the current period. When it comes to ratios for analyzing a stock, I don't expect you necessarily to become an expert and memorize all these ratios, but I do want you to know that Wall Street cares about this stuff. and they are the big money driving the price. So you should at least know what these are and why they are important. And retained earnings does directly feed into the return on equity ratio. I'm not going to go into that in this video because I just did a ROE video for you guys 3 weeks ago. I'll put a link to it up here and down in the video description. Go watch that. It's a very important ratio to understand. Number 2, though, is the dividend payout ratio, sometimes what we just call the payout ratio. And that is the total amount of dividends that a company pays to us, to shareholders, relative to its net income. This is not dividend yield. This is a dividend payout ratio. So of the retained earnings that the company had in the period, what percentage of that was paid out in dividends? And the formula for that is dividends paid divided by net income. If you are going to analyze a stock and you want to know where to find those ratios, just go to a tool like stockanalysis.com. This is free. Click on the financials tab, then ratios, and down at the bottom, you can find things like the ROE or the payout ratio. I've heard people on social media making fun of Home Depot, saying it's trash because their assets and liabilities are very high and they're almost equal to each other. The shareholders' equity is very small and the amount of cash on the balance sheet is really low. But what they are missing, what they don't know to look for, is things like return on equity over 500%. Payout ratio on dividends over 60%. You want to know why Home Depot is doing better than your favorite stock, why Home Depot is trading at $370. Start paying attention to the things that matter to Wall Street. Quick little thing to remember about the payout ratio is that if a company is not paying dividends, its payout ratio is going to be 0%. And if they are taking all of their retained earnings and paying it out as a dividend, their payout ratio would be 100%. The third and final ratio that we're going to talk about is the retention ratio, which is the proportion of earnings kept back in the business as retained earnings. Remember, we had our revenue, we subtracted our expenses, we had retained earnings left over. We might have paid some of that out as dividends, and whatever is left, that proportion is the retention ratio. The formula for that is very easy. 1 minus the payout ratio that we just calculated in the previous slide. We could also look at earnings per share minus dividends per share, and then divide that result by earnings per share. So 2 ways you can calculate the retention ratio. With that out of the way, I think we've hit all of the high spots, all the things that I wanted to convey to you, at least in one quick video, going over what is retained earnings, what do you need to know about it, why might Wall Street care about retained earnings, and if retained earnings are negative, is that a death sentence for a company? The answer is no, if the company is able to return to a profitable status. And by returning to a profitable status, really what I mean is, as I said earlier, if the company is able to flip from losing money every quarter to generating profits and free cash flow every quarter, then the outlook from Wall Street is rapidly going to change, and there'll be much less focus on the fact that the retained earnings is negative, because the trend will reverse and Wall Street will see that retained earnings is improving. If you have any questions or comments, please leave them for me down below. I love to hear from you guys. I am Tony Denaro. Thank you for watching, and I will see ya on the next video.